Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Astera Labs Inc. annual report. Astera Labs Inc. offers a wide range of semiconductor-based connectivity solutions for cloud and AI infrastructure. At the core of its offerings is an intelligent connectivity platform that integrates microcontrollers and sensors with Cosmos software suite. The company's product portfolio includes various components such as PCIe/CXL smart DSP retimers and cable modules, Ethernet smart cable modules, CXL memory connectivity controllers, and smart fabric switches. These products cater to the needs of hyperscalers and system original equipment manufacturers, providing them with efficient and optimized connectivity solutions for their cloud-scale infrastructure. The Cosmos software suite is a key component of Astera Labs offerings, enabling management and optimization of resources through link, fleet, and RAS, reliability, availability, and serviceability management capabilities. Overall, Astera Labs provides a comprehensive range of businesses and services that cater to the growing demands of cloud and AI infrastructure. Its innovative products and software solutions aim to improve connectivity, efficiency, and scalability for its clients in the hyperscale market. Astera Labs Inc. has experienced a significant stock price increase of over 53.23% in the past year due to several positive news events. The company's initial public offering, IPO, in March 2024 was a pivotal event that established a strong initial trajectory and investor confidence in the company's potential within the AI infrastructure market. In May 2025, Astera Labs announced an expanded collaboration with NVIDIA to advance the NVLink Fusion ecosystem, integrating NVLink connectivity solutions into its intelligent connectivity platform. This strategic partnership aimed at advancing the silicon ecosystem for next-generation AI infrastructure was announced in June 2025 with Alchip Technologies. Astera Labs' strong financial performance has also contributed to the stock price increase. The company reported robust financial results for the second and third quarters of 2025, with non-GAAP diluted earnings per share, EPS, of $0.44 and $0.49, respectively, significantly surpassing forecasts. Revenue surged 150% year-over-year to $191.9 million in Q2 2025 and 104% year-over-year to $230.6 million in Q3 2025. The company's ecosystem collaborations at the OCP Global Summit 2025 and its joining of ARM Total Design further emphasized its role in advancing open standards for AI infrastructure too. The acquisition of AI Xscale Photonics expanded Astera Labs' capabilities in optical connectivity, while the opening of a new Israel Design Center accelerated the development of next-generation scale-up fabrics. The company's fourth quarter and full year 2025 financial results were also robust, with an EPS of $0.58 and revenue of $270.6 million, a 92% increase year-over-year. Full year 2025, revenue reached $852.5 million, up 115% year-over-year, showcasing the company's strong growth and pivot to profitability. These events collectively highlight Astera Labs' accelerating growth in the AI and cloud infrastructure markets, driven by its innovative connectivity solutions, strategic partnerships, and consistent financial outperformance. Astera Labs, Inc., market capitalization of $22 billion, is materially smaller than most of its industry peers of roughly $36 billion. Astera Labs, Inc. trades at a higher price-to-earnings ratio of 106 times, and a higher price-to-book ratio of 16.12 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 9% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be identified through various factors. On the growth side, sales volume and product shipment, customer adoption of patented software-defined platform approach, and growth from hyperscalers and system OEMs customers are key contributors. Additionally, proceeds from equity issuances and cash generated from sale of products also contribute to revenue growth. On the decline side, significant losses from operations in prior years, negative cash flows from operating activities, warrant-related reductions, decrease in gross federal net operating loss carryforwards, and increase in valuation allowance are major drivers. These factors have a direct impact on the company's financial performance and can lead to revenue decline. Regional trends also play a crucial role in determining revenue growth or decline. For instance, Singapore has seen an 856% increase in revenue from 2024 to 2025, while China has experienced a 253% decrease during the same period. The United States has also shown significant growth, with a 143% increase in revenue. In terms of financial metrics, research and development expenses have increased by $5.4 million, 7% growth, from 2023 to 2024, while sales and marketing expenses have decreased by $56 million, minus 37% decline, from 2024 to 2025. General and administrative expenses have also decreased by $24.3 million, minus 39% decline, during the same period. Overall, a company's revenue growth or decline is influenced by various factors, including customer adoption, product shipment, regional trends, and financial metrics. By understanding these drivers, companies can make informed decisions to drive growth and improve their financial performance. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, the company reported a net loss of $26.3 million in 2023, which worsened to minus $83.4 million in 2024. However, there was a substantial improvement in 2025, with the company reporting a net income of $219.1 million. The profit margins also experienced a notable change during this period. In 2023 and 2024, the company reported negative profit margins of minus 22.7% and minus 21.1%, respectively. Conversely, in 2025, the profit margin increased to 25.7%. The reasons behind these changes are not explicitly stated, but can be inferred as resulting from a combination of factors such as shifts in revenue, costs, and market conditions. The improvement in net income and profit margins in 2025 suggests that the company was able to address its financial challenges and capitalize on opportunities during this period. However, without further information, it is difficult to pinpoint the specific reasons for these changes. The company is generating positive operating cash flow, indicating a strong financial position. According to the financial statements, in 2025, the net cash provided by operating activities was $319,306 million, which is a significant increase from the previous year of $136,676 million. This trend suggests that the company's operations are generating sufficient cash to cover its expenses and investments, resulting in a positive operating cash flow. The company's financial health is a pressing concern. A significant increase in debt levels has been observed over the past year. In 2024, the company had a manageable debt of $89,709. However, by 2025, this figure skyrocketed to $168,189. This substantial rise in debt indicates that the company may be facing financial difficulties and struggling to manage its liabilities effectively. Management is emphasizing the importance of risk management as they navigate changing market conditions. To achieve this, they are continuing to invest in product development and research and development, expecting these expenses to increase in absolute dollars. The company's growth expectations are subject to fluctuations due to varying business conditions, but management remains confident that their current cash reserves will be sufficient to fund operations for at least 12 months. However, future capital requirements will depend on several factors, including growth rate, sales and marketing expenditures, R&D expenses, and market acceptance of products. Management's focus is on long-term financial planning, as evident from their use of a discounted cash flow model to value intangible assets acquired through business combinations. This approach suggests that the company is prioritizing sustainability over short-term gains. Notably, management has stated that they do not expect to issue dividends in the future, indicating a commitment to reinvesting profits into the business. Overall, the company's strategy appears to be centered on prudent risk management, strategic investment, and long-term financial planning. The company has made it clear that they have no plans to pay out dividends to their shareholders in the near future. In fact, they explicitly state on page 34 that they will not be paying dividends on common stock for the foreseeable future. This decision is further reinforced by a dividend yield of 0, which indicates that there are currently no dividends being paid and none are expected in the future. There are significant concerns about inventory buildup and supply chain disruption in the company's operations. One of the primary risks is the potential for excess and obsolete inventory due to inaccurate demand forecasting, delayed customer orders, and fluctuations in product mix. This can negatively impact gross margins and lead to a decline in revenue and results of operations. The company's reliance on third-party manufacturing partners also poses significant risks, including failure to manage relationships, unforeseen disruptions to production or distribution, and potential shortages of materials. The concentration of chip manufacturing in Taiwan is another concern, as it makes the company vulnerable to macroeconomic trends and geopolitical events. Furthermore, trade restrictions, tariffs, and export controls can limit the company's ability to obtain equipment, components, or raw materials, leading to increased costs and reduced demand for products. Raw material price fluctuations and decreased availability of certain raw materials also pose a risk to the company's operations. The data on total inventory levels is also concerning, with an increase from $43.2 million in 2024 to $58.9 million in 2025, indicating a buildup of inventory that may not be sold or utilized efficiently. Overall, these risks highlight the need for the company to develop strategies to mitigate supply chain disruptions and manage inventory levels effectively. That concludes the financial summary for Astera Labs Inc. Feel free to comment below, and I will be happy to answer them when possible.